Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We start strong this morning with Monica DiCenso joins us. Thrilled to have her in here from JPMorgan. I got to go over year to date. Dow up 6, S&P 500 up 10, NASDAQ Composite up 12%. And as you say, surprise, it's a great year for equities. Is the message out there?
I mean, people are still skeptical and nervous, which is funny because it's been an amazing year by any measure from an equity standpoint.
And
yet people don't feel great.
7 months.
So you could argue we could just go home and enjoy the rest of the year and call it a day. But I think the challenge for many people I work with, they're still sitting in a lot of cash. So I would argue not everyone has participated in that equity rally.
Well, not only has everyone participated, but there's a rent here between the retail investors, I guess, participating, and institutions have outsmarted themselves. Is that how you see it?
Yeah, I mean, I think to a degree the retail investors tend to overanalyze, right? Because there's a fair amount of recency bias that creeps in there. And you can't underestimate, again, 2022, it was a few years ago, but it's still very recent to people's minds, that the fact that when volatility happened, nothing worked. Equities were down, bonds were down. And that's the big challenge I've been having to get people to move out of cash and look at fixed income as a real significant allocation in their portfolio again.
Paul, the Madrid Stock Exchange in U.S. dollars, I think it's up 32% year to date.
I guess we missed that again.
My word.
Monica, when you talk to some of your largest, clients, your high net worth, ultra high net worth clients, are they fully invested, do you feel? Or do you feel like they're still just kind of cautious out there?
Still cash balances that are a bit too high. If you go back over the last 10 years, we still see cash balances like 30-40% higher than what I've seen in the past. From their old balances, right? So some, I'd see like 15, 20, 25% cash balances, which is too high for people with generational wealth, which you would argue they should have almost no cash because they don't need it, right? They don't need the cash.
So in fixed income, you can actually get real returns here today, even like municipal bonds. I mean, I don't know where
if you're a U.S. taxpayer, munis are a no-brainer. If you like me, you have the privilege of living in New York City, it's especially no-brainer. You're talking high single-digit tax equivalent yields with, I would argue, much less risk than you're going to get in equities. So probably do better than I think you will in U.S. equities over the next 12 months with less risk. That seems obvious.
How about alternatives? I mean, private equity, hedge funds, private credit, real estate. I mean, how do you guys talk to your clients about alternatives?
It's a big allocation for large families because, again, they don't need the liquidity. So you tend to see allocations in alternatives. They could be as high as 50% of a portfolio.
Really?
Yeah. It's not where we start, but that is what I see for some of the larger families.
I've heard that.
You have a great, the blue button, the Detroit Lions blue button.
Yep.
You have a wonderful resume for this question. Forget about family net worth, JPMorgan mega hitters, with 8 zeros off to the left of the decimal point. Should people have alternative investments in their 401k?
If for long-term money, yes, because, data tells me you're going to compound at a rate higher than you would in public markets. Now, that said, there is a different risk profile there, and you always want people to be comfortable with that risk. And so it depends what age you are, right? If you're in your 30s or 40s, that wouldn't scare me. If you're in your 50s, 60s, 70s, you're tapping into that money sooner. That's a different question. It probably makes less sense.
You mentioned cash earlier. What's the to-do list for Monica DiCenso going into Labor Day? People are like, I need to do action. What's the action mandate?
If you believe what the market is telling you, which is the Fed is going to cut in September, you need to own more fixed income because your cash is going to earn you less. And it seems so obvious, but people don't believe it because I think they've been hearing people like me say, cuts are coming. They haven't been coming as fast as people thought.
Right. Do you want to weigh in on NATO?
It's a thing I talk about with a lot of clients, but then I have to remind them, do not let your geopolitical concerns let the tail wag the dog because generally speaking, over any intermediate term, it doesn't matter for markets.
It's a nuts summer.
Yeah, it is.
Yep. Where were we? 240 days into the term. Monica, thank you so much. Too short a visit. Let's do this sooner. Monica DiCenso is with JPMorgan. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Jim Caron, Torsten Slok publishes moments ago at Apollo Global Management on what I walked in the building and looked at today, which is the yield curve. The vanilla curve is comparing the 2-year yield with the 10-year. I went out and looked at the 2-year as compared to the 30-year yield. And the answer, I think a lot of people, Jim Caron, don't know this. Going back 30 years, the steepness, the difference in yield of the 2's30 yield curve is not even back to normal. We were so negative. We're still trying to get back to normal. Is that right?
That is absolutely correct. If I look at, there are various curves that people look at. Some people look at the 3-month T-bill rate versus the 10-year yield, and some people look at Fed funds versus 10-year. If you look at the yield curves right now, we are still below historical averages. So the curve has a lot more it could potentially steepen, and that has a lot of implications, right? Because in one sense, we're talking about Fed rate cuts, and yes, that means that front-end rates can come down. But it doesn't necessarily mean that back-end rates actually have to come down. And that might actually be not exactly an intended consequence if you're trying to lower mortgages or longer-term borrowing rates.
I mean, within all this is the basic idea, Paul, am I right? A steeper yield curve is evil? I mean, Fibonacci 101?
Yeah, I don't know.
Jim Caron, is a steeper yield curve bad for our listeners and viewers?
No, not necessarily, right? So it depends on why the curve is steepening and what the conditions are that are surrounding it. So in some cases, a steep yield curve is actually really positive for the financial sector and for banks. Why? Because banks borrow at the short term at a low interest rate, and they lend longer term. So therefore, the spreads get wider. Banks can earn more money, and what that means is that banks are more willing to lend into the economy. So that could actually be a positive thing. So usually, a steeper yield curve could be a positive. The other thing that also it creates is some form of easier leverage, meaning if you can borrow at those shorter term rates, at those lower rates, and you can invest longer term, then you could actually generate more potential revenues. But usually the yield curve steepens when the Fed starts to cut interest rates aggressively, and that's usually in response to something bad happening in the economy. So that's the coincident component of the indicator that you may be referring to, Tom.
Hey, Jim, tomorrow Tom's going to get on the Gulfstream and head out to Jackson Hole. What are you looking for from Jackson Hole, Fed Chairman Jay Powell on Friday?
So I really think that he's not going to alert us to a potential rate cut, but I think he's going to open the door. I think what he's going to do, his mission is ultimately just to basically say that the risks are more balanced and potentially tilted to the downside, especially as it pertains to the employment situation. That gives him the opportunity to cut interest rates. Now, we have a payroll number before the next Fed meeting in mid-September, and we also have inflation data coming out. The payroll numbers coming out over the next several months are not going to be good. I think it's on September 9th. We have the quarterly census of employment and wages. This is that downward revision that we're supposed to get in jobs data. So we may actually start to realize that our monthly jobs rate of growth over the past 6 months or so has actually been a lot worse than what's actually been reported by the BLS. So I think the labor data is sending a very strong signal that the jobs market is not overly strong right now. And I think we know that. And I think that opens the door for the Fed to cut interest rates. And I think that Powell will probably allude to something along those lines with respect to the labor market.
Jim, you're the CIO of Cross Asset Solutions. I have no idea what that means, but I'm guessing it means you and your team can look at a lot of different places for value. Where do you see value these days?
Yeah, so effectively what we're seeing right now is actually equities look a bit more attractive than fixed income does. Now, let me explain that. So clearly fixed income has a higher yield, it has a higher coupon, and it's good. It's a very good, stable place to put your money, and it's a good component of a portfolio for diversification. However, we think that within the equity markets, if you look at the broader parts of the market, so not the top flying Mag 7, but the other 493, what we're starting to see right now is a broadening out of earnings revisions to the upside. In fact, second quarter earnings, which just came out, were actually very, very strong from a historical standpoint. Were very strong, that many of these companies in the second quarter actually beat expectations quite significantly. And that is actually portending to something relatively strong going into the future. So when we think about the markets and we think about the next 6, 8, 9 months ahead, I don't like to think very short term, but if we think over that period of time, what we have to recognize is that we have some tariff fallout that we're going through right now. Inflation's likely to be higher over the next couple of months. But once we get beyond that, what we're left with is a lot of business investment, a lot of CapEx, a lot of companies starting to invest in their own future. And I think what that's going to do is increase private sector jobs growth. And I think that's a positive.
Are you managing for the coupon right now, or can you actually make total return forward?
That's a great question, Tom. What I've been saying in fixed income is I'm managing for the coupon right now.
Yeah.
The reason I say that,
do you realize that only 12% of our audience, Jim Caron, has ever done that because there wasn't a coupon?
Yes, yes. Well, that is true. But well, effectively, I think that the duration movement. So what Tom is referring to is if you get this drop in interest rates, you get this increase in price, this total return just in terms of price. Yeah. I think that interest rates have already fallen reasonably enough at this point. They may fall a little bit more, but I don't think that's going to be the majority of the gain. I think the majority of the gain that you can look for in fixed income is the yield or it's the actual coupon. Yeah. So for fixed income, it's really a question of that stability, and you can add that to your portfolio for diversification, which is what we're doing.
Paul Sweeney's been lecturing me on that on a daily basis. Jim Caron, thank you so much at Morgan Stanley. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
We speak with Douglas Cass, a piñata on Wall Street. People love to go after him, but the fact is it's an esteemed career starting out at Kidder Peabody. A zillion.
How many people started at Kidder Peabody?
A lot of people did. I mean, it was great firm. Doug Cass joins us now with Seabreeze Partners. He has been cautious on the market and wrong. Doug, I just looked at a toothpaste company. We'll keep the name out. That since the pandemic has made 4.5% return. There's basically two markets. Have you been wrong because you missed Mag 7, or have you been wrong for another specific reason?
That's a good question. I just want to warn you that I prepped for this interview with 1 hour of Peppa Pig and Baby Shark with my granddaughter, Carlin.
That's good.
Look, I'm painfully honest. I don't go on Bloomberg or any of the other shows to improve my brand or sell a service. I try typically to explain my view on the markets, individual stocks, without an agenda to promote. That view, my view, is often a contrarian one. It is today. So I'm going to briefly explain how dumb I've been in the market, but how I addressed and managed through a wrong-sided market view, effectively managing risk and even profiting. I think that it's instructive for your viewers. It'll benefit from my transparency and technique. Because I honestly, to be blunt, few come on market surveillance and say how wrong-footed they've been. The opposite is the case. People usually talk about their successes, their winners in the forum. They want to appear smart and conveniently forget their views and performance during drawdowns like in 2022. It reminds me of the old Harold Arlen and Johnny Mercer's song, Accentuate the Positives, de-emphasize the negatives. So since we last met, and with the exception of the fall in February and March, and really since the S&P was 5,800, I've basically been bearish and wrong. But astonishingly, my hedge fund, Seabreeze, has been net short in almost every month except for the March-April sell-off since early 2024. Despite that, our monthly returns have been positive in 18 of the last 19 months.
But Doug, how have you done that?
I've done it. That's a great question. We employ good risk management by taking a number of small losses rather than get involved in shorting valuation, AI, Mag 7. We shorted the mundane companies whose business models were eroding.
Paul wants to get in here. I want to ask you one question. Paul Sweeney's got a
you can ask me any question
in a short time. I on the Bloomberg have Walmart at a PE of 40.16. Can you explain to me by somebody dropping pennies down to the bottom line deserves a 40 multiple? You're the only one living who remembers the nifty 50. How did we get here with Walmart?
It is astonishing to me. We are been short. Our largest short exposure in the last year and a half have been in consumer stocks. We actually recently shorted Walmart. And I think it's condition of the market. It's what Warren Buffett wrote in a report to his Berkshire Hathaway shareholders in 1999, God's plan. Basically, people wake up in the morning and expect stock prices to go ever higher. So you've seen this substantial expansion, reevaluation in price earnings ratios. And we think that equities are terribly overpriced against interest rates. The equity risk premium is at 2-decade low. That's typically consistent with the slide in stocks. The S&P dividend yield is at a near record low of 1.25%, and the spread between that and the 10-year Treasury has rarely been so wide. As you know, I'm very close to Coops. I was Lee's director of research for a while at Omega Advisors. Lee feels bonds are overpriced, so stocks may be overpriced against overpriced fixed income, and that's no bueno.
Jump in here.
Doug, just real quickly, given that stance, given that conservative outlook on maybe valuation, how are you positioned here today?
I've been net short between 10 and 20%, as I said, for most of the last 19 months. And we are currently considering expanding our net short exposure outside of that range. I think current valuations are 24 times. That's in the 98th percentile. It's a poor launching pad for future investment returns. Bob Farrell, in one of his 10 lessons of investing, said there are no new eras. Excesses are never permanent. The S&P index trailing multiple is 26. You take out the 23 peak in 2021, and it's similar to the valuation of August 2000, right before a 2-year bear market.
I want to pick up on this, but Paul, jump in here with one more question.
Doug, how about in the fixed income space here? Can you go there and just clip coupons here? Is there opportunity there?
I think that if you're a high net worth individual, I listened to your prior segment about just earning the coupon. You can get a 7.5% pre-tax equivalent if you're a high net worth individual in municipals. So I think that 4.3% is thereabouts where the 10-year yield is. It's a good place to hang out. And if you go a little riskier in credit, you get equity-like returns for limited risk and no volatility.
Oh, Doug, I got time for one more question. I got 8 ways to go here.
Don't ask me about the Yankees.
I'm not
if you ask me about the Yankees, I hang up.
No, well, you should. And, it's a glorious and beautiful thing. Doug Kass, I want you to speak to the people listening and viewing who aren't sophisticates. They didn't have an office next to Julian Robertson. They haven't done what you've done. They haven't been as visible in a piñata like you. What do you say to our audience about this addiction, this belief in Mag 7?
Well, I'm, no one I know is concerned that there'll be a large drawdown in equities. And I think there's any number of conditions that could bring down the market meaningfully. And the most important one, as it relates to Mag 7, is a hiccup in AI. For example, a slowdown in AI cap spending could occur. We could see growing evidence of double and triple chip ordering. We could see the failure of AI to improve from its current state. We could see the failure of use sets to develop for AI. We could see an accounting scandal in AI because companies, hyperscalers, are depreciating their massive capital expenditures over 10 years, well in excess of useful life. I've written over 105 columns on the street about that, called More Tales from NVIDIA. I think NVIDIA and the hyperscalers, and I'm long two of them, Meta and Amazon, are over-earning.
All right. Doug, quickly here on Apple. Were you long or short Apple?
No position. I was short
Right.
Into the move under 200, and I have no position. I think it's overvalued, but I think there are far better shorts available.
Can the Red Sox make the wild card?
Red Sox, I believe, are tied with the Yankees, 5 games out. The Red Sox are 4-6 in the last 10. The Yankees are 7-3. The leading team, Toronto, is 5-5. The momentum is with the Yankees. Go Yankees.
Okay, Doug Kass, thank you so much. Get back to Peppa Pig with your granddaughter. Mr. Kass is with Seabreeze Partners. He's been very open about missing a great bull market. Greatly appreciate it. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Joining us now for clarity, Kristen Biddle. It's been way too long. Had a wealth at work at Citi Global Markets. And I guess just this has come up this week, Kristen. Do you believe in rebalancing? Like, is this like a formula?
I absolutely believe in rebalancing. I think, look, like at a very high level, what's the number one question we're getting from our clients is really questioning around like the 60-40 portfolio. And I think it's gotten a little bit of a bad rap because when you look at it over time, just look at it over the past decade, it's been returning around 9% per annum, even year to date. You have 9% per annum or 9% total year to date through the 60-40 portfolio. So I think where the question comes into play, though, is really looking at what does cash provide in this market? Should you have an allocation to cash to be a little bit more nimble? And then also the question that everyone's been discussing around the fact that your equity exposure is actually highly concentrated. Is that a good thing or something that you should diversify away from?
So where do you want diversification? I mean, my basic thing is I see a lot of portfolios over-diversified so that if you have a winner, it doesn't matter because you're over-diversified.
So the diversification across, let's just say like fixed income, alternatives, and equities, certainly a case for it. I think there's a case for having some cash. Now, within our portfolios, we have about a 1% cash allocation. Within our investors.
1%? Why
1%.
bother?
Well, you have a little bit just to do some rebalancing on the edges. But if you look at the average client's portfolio, some of those are upwards of 20 to 30% in cash, which then you have to ask the question, is that really an investment or are you kind of stuck in an inertia?
I love some of this data from the Capgemini report, which I've seen in so many places. High net worth individual wealth showed strong growth in 2024, reaching $90.5 trillion globally. And this is a number I keep telling my number 3 offspring that works at a big investment firm. 63% of global wealth is expected to change hands by 2035. That is unbelievable.
It's unbelievable.
How is that going to happen, by the way? Is that just... I mean, you got to plan for it now, don't you?
You have to plan for it now. And this is something, so the Capgemini team, they've been producing this report for the past 29 years. And this is really kind of one of the leading publications when it comes to wealth management and the broader kind of spectrum of ultra high net worth and high net worth investors. So I was part of the exec steerco this year. And the focus of this is really this great wealth transfer. And so that 63% is expected to change hands by 2035. Right. I think the more important stat there is not just the movement of wealth, but the fact that whenever you have, whether it's like interspousal transfer, whether it's an estate situation, intergenerational transfer, there's 2 key insights. One, within 1 to 2 years, close to 90% of people change their advisor. So simply because you were advising a family does not mean if you have one of these big life events that you're going to continue being the advisor. I think the other thing is when people talk about next gen, it really is people aged 40 to 60. Mm-hmm. You hear something like next gen and you think it's someone in their early 20s or in their teens. That transfer is going to happen first and foremost to Gen X.
Okay, here's what I want to know. For the listeners and viewers that are doing all this estate planning, et cetera, and the kids have no visceral interest in the markets, they wouldn't know yield to maturity if it hit them over the head. What do you do if you have all your kids or some of your kids who they just don't care about the material?
So this is a really interesting question, Tom, because I think it's fascinating and almost kind of ludicrous that you can graduate from the best universities in this country without a foundational knowledge of financial planning, estate planning, and just understanding investments 101. So since we're dealing with that as a base case, and some people are not interested, the educational component and having a trusted advisor becomes mission critical. And so everyone should have a foundational knowledge of financial planning.
They don't.
But they need to.
Okay, they need to. But come on, this is like a huge deal. We have a generation behind us, whether we have, the mega bucks John Tucker has, or you're like me, I can never retire. I mean, Kristen, the kids don't care.
Well, we see them caring, but just in different ways, right? So a lot of the barriers to entry from a technology perspective, hear me out on this, Tom. The barriers to entry from a technology perspective, even accessing financial markets, you've never seen so many people in their 20s and 30s actively trading. And so the democratization in terms of trading is free, access to markets, that was a very different story a decade ago or 2 decades ago. So a lot of those barriers have been brought down. And I think it's a question of meeting people where they're at and also with their interests. So where do we see the primary interests of this next generation? It's definitely in terms of digital engagement and the platform, in terms of accessing advice 24/7, but it's also interest in other asset classes. And you see a higher tendency towards alternatives as opposed to public markets. And I'm not just talking about crypto and what you would think, it's actually alternatives because 99% of the companies in the US market are private companies. And actually, if you say like, okay, fair enough, but a lot of them are small, even if you use the threshold of over 100 million in revenue, you're still talking 90%. So a lot of those themes, you can meet someone where they're at in terms of what does interest them without it being financial planning 101 or kind of the benefits of asset allocation and diversification.
Well, I've told my kids the last check I write, I want it to bounce. So don't plan on anything else. So what are some of the questions you get from your clients? How do I set up estates? How do I set up trust? What do I do with my investments today? What kind of questions do you get from your clients these days?
So I would say the first question, oftentimes when we meet with a new client, right? So if it's an existing client, you generally are going to already have a financial plan in place. You're going to have an estate plan in place, and you're going to have an asset allocation and understanding your risk profile. So oftentimes when we have that initial interaction, and by the way, we cover people in the legal industry, we cover professional services, we cover asset managers, pre-IPO, post-IPO companies. So you're talking about a very diverse set of individuals, but they're very ambitious in terms of their careers and their goals for themselves personally as well as professionally. One of those common things that we find is people have all their money in a savings account.
Right.
So that they have not actually done a financial plan, or that they just simply, they've been saving.
Right.
And they start with kind of a traditional path of, I'm going to buy my first house, I have my mortgage, then I come into liquidity, and I don't even realize, and many people think it's too late. So the question around, like, these are people who are fine from a retirement standpoint, but then really getting an estate plan in place, understanding wealth transfer, and then understanding asset allocation.
Yeah, all I can say, folks, is just on probate alone, get an estate plan in order. Kristen Bitterly, thank you so much with Citigroup this morning there. We don't do enough of that. Can you come back?
Anytime. Okay. I'll be here.
Kristen, thank you so much. Really appreciate that.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.